That's the only thing that you should do here. So the tax rate is 12.5%. It's inside the bracket there. You put it in decimal, 0.125. So it's not 8%. That's the pre-tax cost. It's actually, if you work it out, 8% by 1 minus the tax rate. If you check it with your calculator, you'll end up with an answer of 7%. So the answer was this guy here, B. Again, I think that was not a problem for most people. It's a fairly easy question. If you get a bank loan or a preference share in a question, as we go on and do more questions with you, you'll see they're quite easy. This question was badly answered by most people. And it relates to the fact that you haven't read the question. So let me explain what's happening with this question. Again, the usual 5 choices, no negative marking. As I read the question, what's it about? An investor has €100 of 8% loan stock, or a debenture, if you like. What does that mean? It means some guy has lent money to a company. They've given the company €100, and the company is promising to pay 8% interest on that borrowing facility of €100. The market value is 80x interest. That's if this investor wanted to sell their debenture on the stock exchange, they could get €80 for it. The corporate tax rate is 12.5%, nothing to do with the investor, but that's to do with the company. The company pays 12.5% tax. That's corporate tax. What is the question? What interest will be received by the investor? And I've underlined it here. The question is simply asking you, what would the investor get every year? Well, it's simple. The investor is giving €100 to the company, and the company is promising to pay 8%. The answer is 8% of 100. So the answer to this question would the investor would receive 8% of 100. I have no information on income tax. The corporate tax has nothing to do with the investor, it's to do with the company. So it's just a case of maybe people didn't read the question appropriately. It looked like, well, let's just read the question. What interest will be received by the investor? There's no more to be said. So be careful. Always read the question. Never answer the question you want to answer. Answer the question that's asked. That's important. Okay, and then the very last question here is the one that I asked, and I know Niamh will go through her own solutions. The very last question was to do with what's called net present value and internal rate of return. So you were given a bunch of old cash flows here. And these are a series of cash flows, negative 240, 120, 120. These are all positives. And then it says, it may have given you a discount factor as well. It's irrelevant. If the year 3 cash flow was actually 250,000. So if the year 3 cash flow was not 160, but was actually 250,000, what would be the effect on the IRR? That's the return on the investment, and the NPV, the net present value of the investment. Now, you don't have to do any calculations here. You're looking at cash inflow. This is an outflow, and these are all cash inflows. If the 160 was wrong and it should have been 250, what do you think would happen to the return on the investment? Well, 250 is much more than 160, and it's a cash inflow, so it's a really good thing. So you'd imagine the return would go up. And in the same way, when I'm working out net present value, there's a series of positives and you've one negative. If one of the positives goes up, it would improve the positive present value cash inflows. So you'd expect the net present value to go up as well. If that's not 160 and it's 250, it's going to be a good thing. The return should increase, and so should the NPV. So all I was looking for that you'd identify the appropriate answer was both of them would increase. The return on the investment is going to be improved, and the positive scores here will be improved if this is 250, not 160. So the answer in this case was D, increase and increase. So it's just if you understand that the cash inflows are better, what's going to happen to the return on the investment is going to be better. What's going to happen to the NPV? It's going to be bigger. That's basically it. So I think in fairness, the results were quite good. But that style of exam is not relevant for the, from your point of view, for the next stage, which will be the exam that's happening at Christmas or in December or whatever. So what I wanted to do with you today, the results are up on Moodle. You can check out how you got on and stuff. But in the main, they were good. What I wanted to do today with you was get you to a situation where you were able to look at a question where there are many forms of finance, and your angle here is to try and figure out the cost of each individual one. So what I'm going to do with you now is bring you back to the course, and really the page I'll be looking at, assuming you did the work you were supposed to do last week, whatever, would be page 11. We finished up on page 10 last week, calculating what's called an internal rate of return. And maybe you practiced that over the course of the week. But anyway, let me show you what we've done so far. We've looked at different forms of finance, and we've looked at, for example, we've looked at what are called ordinary shares or equity. And what I mean by this overhead will go up on Moodle later. I'll put up the overheads from today up on Moodle for you. But DVM, just dividend valuation model. It's something, if you're reading textbooks, you'll see that's the idea. We're looking at a company that's paying dividends to the shareholders. And there are formulas available for what are called ordinary shares or equity. Equity means the ownership of the company, the people who own the company, the people with the voting rights, the ordinary shares. But anyway, for cost of equity, there's a couple of different models. One of them is where there's a constant dividend. Now, I don't give you this formula in the exam. I give it to you in relation to what's called a preference share, but that formula is available, but it's usually to do with a preference share because preference shares pay a constant dividend. Usually for ordinary shares, if a company pays dividends, the idea would be that it'd be some kind of growth happening. So this formula is given to you in the exam if you ever see a situation where there's growth in the dividend payout. You might be reading different textbooks, and on the right-hand side here, I'm showing you something you might see in other books. D1 means the dividend 1 year from today. It's the same as your man here. Next year's dividend over price plus G. These are identical formulas, just different formats. This is the one I give you in the exam if there's dividend growth. If you have a situation where you have a constant dividend, I give you this one for preference shares. So that kind of covers that guy. So if you have a constant dividend, put it over the price. If you have a growing dividend, it's a more complex formula. And that covers what are called dividend payout formats for what are called ordinary shares or equity and preference shares. They're available to you for exam purposes if you need to use them. And then what I did with you was I showed you what's called the earnings distribution format and how companies distribute income annually. And I explained that interest is considered to be an expense that you can take away before you pay any tax. So interest is tax deductible. That led on to the next form of finance, which was an old bank loan. And really for you, the cost of the bank loan is the interest rate, but for a company, it's a tax write-off. So the interest rate has to be adjusted. The cost of a bank loan is the interest rate by 1 minus the tax rate. So this overhead here is just showing you what we've covered so far. And you saw it a few minutes ago. I did an 8% loan there with an after-tax cost of 7%. That's just something to be familiar with. That formula is not given to you in the exam. You're supposed to know that because you've seen the relationship between interest and tax. Another format or formula that's available to you in the exam, you don't have to memorize, is what's called the cost of irredeemable debenture. Usually what is equity and preference shares are considered irredeemable. What I mean by that is they're a permanent source of finance. Same with a debenture. If you have a permanent loan from the public, and all you've got to do here is identify the interest that's payable, adjust it for tax, and put it over the price. You saw an example a few minutes ago. So that formula is given to you. This formula here is very similar to this one. It's just dividend over price. This is interest over price, but interest, of course, is tax deductible. That 1 minus T kicks in here. And last week, I showed you that if you have a redeemable debenture, there's no formula. Because when I talk about a redeemable debenture, it means that your company is borrowing from the public, but it's not borrowing forever. It's borrowing for a number of years. It might be a 3-year or a 5-year or 7-year or 10-year situation. When you have a situation where the time frame is limited, there's no cute formula you can use. Unfortunately, you have to figure out the cash flows over that time frame and then calculate an internal rate of return. That's where we stopped last week. I did a question, and you have it on page 10 in your notes, a full format of how to calculate an IRR. And as homework, I told you to have a go at the practice question on the bottom of that page 10, which you possibly did, I'm not too sure. But today, what I want to do today with you is let's put it all together. And what I'm going to show you now, I'll introduce you to questions on page 11 in your notes. On the top of the page, we have question 1, then question 2, question 3. So I'm going to look at question 1 here. And just for a couple of minutes, I want you to have a read of this question. What will happen to you in an exam coming forward here around early December or something? I'll be giving you a question on the paper where I'll give you a set of information and I'll ask you to calculate the cost of the capital for each source. So let me show you this example. I'll put it up in front of you for a couple of minutes and let you have a read of it. What is important in all questions, I'm sure you're cute at doing exams, you've been doing them for years. You go straight to the question first of all, and then you sort of read the question on the basis of what was asked. The question here is calculate the cost of equity, the cost of preference shares, and the cost of the debentures. So before I read this question, I'll be looking for how do I figure out cost of equity, cost of preference shares, cost of debentures. I already know before I read the question, there are 3 forms of finance. So as you're reading this question, just be careful for a few minutes. Now, what I'll let you do just for about 3 or 4 minutes, have a read of the question. See, can you see what's going on here? And then what I'll do on a document reader, I'll show you how I take note of the numbers here and how I'd approach the question. So just for 3, 4 minutes, maybe have a read, and then I'll come back to you and I'll show you what to take note of. And let's have a go at this question. So just I'll take a little break for 2 or 3 minutes and let you have a read of this. So what I'm going to do, I'm going to put on my document camera here, and as I read the question, you have the question in front of you, maybe in a handout format, or you've just read it and you know what's involved. But I'll just show you what I would take note of here if I was doing a question on this, and the style you don't have to follow, but it may be a help to you. So I'm going to open up the document camera for a minute and show you an example of how I'd approach this question. As I read the question, I take note of information. So as I begin to read, I'll see some company has an issue, ordinary shares of 1 million. So I see something to do with ordinary shares. I'm going to call that equity or something. And I'm going to say, okay, there's 1 million shares. So what I do when I read a question is I write down information that might be useful. When you're messing with finance or management accounting or taxation or anything to do with numbers, just take note of some numbers that might help you solve a problem. I know in this question I have to get the cost of equity, cost of preference share, and cost of debt. So I was trying to separate them. What happens sometimes in questions is people mix up all the information and it goes haywire. So try and separate the stuff. So what do I see? I see 1 million shares, current market share price, €4 ex interest, or sorry, ex dividend. So I have a price, we're good. And €4. And then I have another piece of information. Over the past 6 years, the dividend paid has been as follows. Now, this is not dividend per share. It's telling me that there's been a historical growth pattern. So, you got year 1 and 2 and 3 and 4 and 5 and 6 or something like this. And the dividends, I'll just put them in thousands, like for example, we're talking 300,000 at the beginning. It ended up at 500,000. And the 500 there is what's called the current dividend. The current dividend is 500,000. That's explicit in the question. So what I get from all of that, well, I would have figured out that's some kind of growth happening there. There's some growth because I can see it visually. 300 to 320, 350 to 380, 450, 500. So it's kind of growing. Because it's growing, I'd know immediately then, okay, the appropriate formula to use, which is available in the exam, is the dividend growth formula. So I'd be using that kind of guy there. And I just write, that's gone now. I'm finished with the first piece of information. So something to do with equity, cost of equity. I have a problem here. What have I got to do? I got to figure out what's the dividend per share? What's the price? I have the price, €4. And what's the growth rate? Bit of hassle there, right? But I'll figure it out in a few minutes. Then it says the company has 6% €4 nominal preference shares. This is a thing called a preference share. So I'm going to write down a few pieces of information. 6% and €4. I know the dividend already. 6% of €4 is 24 cents. These are preference shares. They pay a constant dividend. And then it's currently trading at €2 per share ex-dividend. So I have no price. The original price was €4. That's called the nominal value or the par value, the original price. But it's now trading at 2 for whatever reason. People buy and sell these things. And the demand supply is dictating the price is not anymore 4, it's 2. How do you work out the cost of a preference share? I'd know at the back of my exam paper, there's no formula, but just put the dividend over the price. You probably find that easy. And then there's another form of finance. It also has 8% irredeemable debentures. I'm going to just call that a letter D or something. You don't have to follow my routine. I'm just saying keep it separate. That's important. It is 8% irredeemable. So the 8% is the coupon rate. Irredeemable is nice because when you see irredeemable, there's a little formula to work it. Irredeemable means a permanent form of finance. Just like ordinary shares and preference shares, they're kind of considered irredeemable. They're going to last forever in theory. What are we talking? Nominal value is 100. That's always the case. So if you don't see this in a question, if you're reading textbooks, you might sometimes not get that info. But invariably, they're in units of €100. These are just borrowings from the public. People out there lend money to the company. The company promises to pay 8% on each 100 unit lent to the company by the investor, if you like. And in this case, we have a trading price of 80 x interest. So I have an old price, just as I'd like. That means on the stock exchange, believe it or not, people buy and sell debts, if you like, buy and sell loans. They buy and sell them just like shares. And, there is a price, market price of the debenture. The tax rate is 12.5%. That's kind of important because interest is what's known as tax deductible. So I have a tax rate. So what you'll see, the way I'm writing it down, I'm just taking a note. I'm separating the stuff. I don't want to get mixed up. And I need to get the cost of what's called an irredeemable debenture. Now, in your exam paper, you'd have a formula for the cost of an irredeemable debenture. It's just the interest adjusted for corporate tax. Here, I lost a bit of that, sorry. Positioning here is a bit shook. Anyway, I think you can make that out. So basically, I have a formula. So what am I doing here? I'm working out. I've got to figure out the cost of the equity. I've got to figure out the cost of the preference share and the cost of the debenture. Now, I'm not going to do it for you immediately because this is kind of revision, believe it or not. You've done each of these before. You've done it, but you've never seen them all in the one question. So what I'd like you to do is maybe have a go at the equity and the preference share and the debenture. Now, I'll give you 10 minutes or so, and it may not work out for you. Don't panic if you're, geez, I know where to start or whatever. Don't in any way panic. My job is to sort of show you an example, bring you slowly through the solution after you've tried to have a go at it, and then we'll do another question. And we'll do two or three questions until you're reasonably okay before I go on to the next stage. So if you have a question, you want to ask something, just unmute your mic. Or if you want, you can put something in the chat box. But I'll just give you 10 minutes to see, can you come up with something here? Now, obviously, there's a bit of grief here. You have to work out the growth rate and the dividend per share. But I think you'll be well able to do it. I hope you are. So give you 10 minutes. maybe show you a few little pieces of how to solve the problem here. And again, if you're totally lost or something, don't in any way panic. Anything to do with finance, anything to do with technical, it's just practice. And I know what's strange about finance is the language, all these crazy expressions, price ex dividend, and strange terminology, irredeemable debentures, but just try and get a little bit of a feel for, as I bring you through a solution, that you can begin to find common sense here. There's something that's happening that makes some kind of sense. But at the beginning, it can be kind of strange. What I'm going to do is I'm going to share with you, you have what I wrote down with my bad writing here. You can see some sort of stuff. But let me just show you how you could approach this, and I'll give you a better visual because you don't need to see my writing that much. But it gives you an idea of what I'd be looking for. Now, my start off point is I'm going to look at what's called the cost of equity. My opening line, I had taken note of 1 million shares, and I'd also taken note of the current dividend at 500,000 euro. So the current dividend is 500,000 euro. It's like the current amount of money available for all of the shares. And there's 1 million shares in this company. So there's a bit of a hassle here, but you have to sort of take the money and split it 1 million ways. So there's 500,000 available for 1 million shares. All you're doing there, if you want to use all the zeros, you've got 500,000 written down and then divide it by 1 with 6 zeros, 1 million. If you prefer, I would go on the basis of 500,000. That's 500,000 divided by 1. Half divided by 1 is a half. Half of a euro is 50 cents. So what have I just worked out? The DPS there, and just the terminology, I suppose, dividend per share. The 50 cent is just taking all the money divided by 1 million. You don't even get a euro, you get half a euro each. And that's the dividend that I need. That's the actual current dividend. And that's very important. It's part of the formula. I know the current share price, which is nice and handy, but I have a problem with growth here. So again, I've kind of shown you a few times how to work out the actual number of years. If I give you 6 years of data, it represents 5 years of growth. The base year is year 1 at 300,000. And then when you get to year 2, that's 1 year's growth. And if you repeat that a few times, you'll see that's 5 years on top of the base year. The expression for 5 years growth is 1 plus g to the power of 5. 1 plus g is 1 year's growth. If you get it to a power above that, then it's the number of years, in this case, 5. And we'll be talking, started at 300, ended up at 500. So just put the L 500 over 300. So what am I saying here? I'm saying the overall growth was about 66%, 67%. See, it went from 300 to 500. That's a 200 on top of 3, which is 2/3, or if you like, 0.66 recurring. So what am I saying? I'm saying the overall growth is about, to the right of the 1, 0.66. It's about 2/3, or if you like, 66.6% or 66.7% growth. And then I have to figure out what number multiplied by itself 5 times gives me 1.667. And this is just a case of getting rid of that power of 5. You saw this earlier on. To get rid of the power of 5, you get what's called the reciprocal power. Get the whole thing to the power of 1 over 5. When you do that, you effectively drop kick the 5, because in maths, you can multiply powers. 5 multiplied by 1 over 5 is effectively 1. Anything to the power of 1 is itself, 1 plus g on the left. What you do to the left, you must do to the right. So again, the same old crack on the right-hand side. I had 1.667. I get it to the power of 1 over 5. Or if you refer to the power of 0.2, that's what I tend to use. 1 over 5 is 0.2. You can also use the root function on your calculator. You need the 5th root if you know how to use the root function. Anyway, what am I doing? I'm letting the calculator do all the work for me here. I just put in the number, 500 over 300. I hit the power function. I hit 0.2. I get an answer. The answer is 1 plus g is 1.1076. If you multiply 1.1076 by itself, effectively 5 times, you get 1.6667. So what's g here? If I drop kick the 1 on the left and the 1 on the right, g is 0.1076. And now I have the 3 pieces. I have the dividend, I have the growth, and I know the price, and the question was given as a score of €4. So there's the 3 guys. Now what'll happen is, I know there's a lot happening here. This is the hardest part of the question. Can you work out the growth rate? The dividend was a little bit of a hassle, not major. I was given the price. There's a formula called dividend growth model formula. So your problem then is to put in the numbers into the formula. So it's easy enough. That's 50 cents. That goes in there for the D. You multiply that by 1.1076. What you're doing there is finding next year's dividend. It'll be about 55 or 56 cents. You put that over the price. If the dividend is in cent, you better put the price in cent. That'd be 400, and add on the growth, 0.1076. This is what it looks like visually, that kind of crack. So that's next year's dividend. That's what the company will be paying next year, as against buying the share today on the stock market and canceling it. And this is an extra growth factor that's going to keep increasing every year. And then with your calculator, you will generate an answer, and the answer seemingly turns out to be about 0.246. Now be very careful with the calculation here. This is next year's dividend over price, get an answer, and add on the growth rate. Your calculator will generate an answer of approximately 0.246, and you're supposed to know if you multiply that by 100, you get it in percentages, and that's about 24.6%. So that's the first answer there. I'll go through the other two, and I'll look for questions. I think there might be one or two in the chat room. I hope you're okay with this. There's a lot of hassle here now. I appreciate it. This is really difficult if you're seeing this for the first or second time. It's not that easy, but that's the hardest part of that question. When you're looking at the cost of the preference share, it's real easy, because if you look at the question, the preference share was a 6% €4 coupon, €4 situation. 6% of €4 is 24 cents. That's the only problem you have with the preference share. Just put 24 cents over, in this case, 200 cents. It's currently trading at €2, and you'll end up at a 0.12 or a 12%. So I think this one will be easy for you. So the preference share, the formula is given to you. You just need to find the dividend. It's based on 6% of €4, 24 cents. And then you put the dividend over the price. If you put the dividend in cent, keep the price in cent. It's trading at €2. That's 200 cents. And the final one, I'm going to take a break and I'll maybe check for questions. The final one is the cost of what's called the irredeemable debenture. Now, this is the coupon rate by 100, the interest that's payable, 8% of 100. That'll be €8. Tax rate 12.5%, 0.125. Price, she's priced at €80 on the stock exchange. So you just put in the numbers there, 8. I'll put it there for you. 8 by 1 minus 0.125, you get an answer of 7 above the line, below the line, 80. 7 over 80, your calculator generates an answer. It'll be in decimal, multiply by 100 to get a percentage. Now you get 3 answers here. What's important to understand, equity will always be the most expensive. It's to do with the fact that it's the riskiest, it's the most risky form of investment from an investor's point of view. Then preference share is less risk, so lower cost, and the debenture has lower cost again. Interest gets paid first, and it's even tax deductible. So it's kind of cheap. So these are the 3 results for you. And that is a lot of work there. But this is the hard part, your man up here. But what's interesting is that you end up with 3 different results. Now down the line, what I'll be trying to do is come up with one answer. I want to work out the overall cost of capital. But for the moment, I'm just going to do a couple of questions with you where you're trying to calculate the cost of each individual source of finance and trying to separate the data. You don't get mixed up with the pieces in the puzzle. So there's a lot in that. Now you may have a question or two. I'm just going to check what's in the chat room if there's a question or so. So somebody has asked me, Gabrielle or something, is P&L €2? Yeah, the price is €2 for the preference share. So it's €2 for the preference share. It's €4 for the ordinary share. So watch, be careful. Now you don't mix up the stuff. So the price here was €4 for the ordinary share. The price here is €2 for the preference share. This is why we kind of separate the material so you don't get mixed up and don't mix up the price of each different format. The price of the debenture is €80. So there's 3 different prices there. Be careful. That's all. If you're okay with this, and we've done an awful lot of work there, if you, I thought we'd take a 15-minute break. What I'm going to do when I come back is I'm going to do another question with you. I think if you practice these questions with me, if you work with me with these questions, you will find this very doable, but it is about practice. So when I come back, I'm going to look at the second question on the page if you want to look ahead. And all that happens is the questions get a little bit more complex, not terribly. But this example, you had 3 forms of finance: cost of equity, cost of preference, and a cost of debt. It'll be something similar in the next question, but I'll be adding a little bit of more complexity each time. But I'll take a break if you're okay with this. We'll take a break for 15 minutes to go for a coffee or something, or if you want to get a sandwich or something. And when I come back, we will just move on to question 2. We'll only just do the next question, and then maybe I'll give you a little bit of homework for next week, and we can see how we're getting on. So if you want to ask a question, no problem. Unmute your mic at any stage and ask away. Or if you want to put something in the chat box, please do. But do take a break. This stuff is not that easy first time you hit it. So I'll come back again around 10 past 1 o'clock or something. So we'll chat you then. Okay, so not too sure if you're all back, but anyway, we have to have a look at another question. And the second question I want to do with you is on the same page. We're actually talking page 11 here. And like before, what I'll do is I'll maybe just show you the question. I'll maybe jot down the information and then give you a little bit of time seeking you produce the goods. What it is essentially trying to figure out, again, the cost overall of the finance. So I'll put up these overheads up on Moodle for you after the session or so. I'll bring you through the next one. The next question is on page 11. It's very similar. And all I've done with this next question is I've changed the time frame, put in a few different expressions, and I've focused on a redeemable debenture. So it looks very similar. It's about calculating cost of equity, cost of preference shares, and cost of the debentures. There's another little piece on the puzzle here, and that's about, can you work out or can you comment on the costs you found? What's happening here with this situation? And it's fairly consistent. You'll find it across all the questions. But maybe if I read the question for you again, and I take note of some of the information, and I'll just jot down what's important here. So this company has issued share capital of some form, but it's got 1 million shares. That's the same as the last guy. So I'm using more or less the same format, except I change a few things. So I've got 1 million shares. Current market price per share is cumulative of dividend. Be very careful. If you see what's called cumulative dividend, it means there's a dividend about to be paid out and that needs to be found and subtracted. And then you've got some historical information, and we have some time frame here, year 1 and 2, 3, 4, and 5, not quite as number of years as last time, but the same kind of format. We've got some kind of growing dividends. So she starts at something like 300 and ends up at 450, not quite 500 like the last time. The current dividend about to be paid, notice it says that, about to be paid, is 450,000. That's called the current dividend. Now the 450,000, as you know, is not per share, it's for all of the shares. It would have said dividend per share, DPS, if it was per share, but it's actually for all of the shares. We have another form of finance, again, and the cost of the second form of finance relates to what's called preference shares. The kind of stuff we have here, we have a coupon rate of 6% like before, but the nominal value is not €4, it's €2. Made a slight adjustment there. And the current price of the share is ex-dividend 120 or something of that form. And then we have finally the difficult part of this question. The company also has 10% redeemable. Now, when you see the word redeemable, as you saw last week, that means you have a hassle here. Because if something is redeemable, it means it has a limited lifespan. It doesn't last forever. It's not irredeemable. It's not a permanent source of finance. It has a normal lifespan. It might be 3 years or 5 years or 10 years or whatever. The nominal value, as usual, is always €100. That's for an individual certificate. It's €100. But then it tells me they are redeemable at par in 10 years. So at par means at the nominal, means the company gives back exactly what it took in originally. So that will be €100 always for you. Now the company might have raised millions and millions of euros. I'm just looking at one of the actual debentures, and they're trading at a price. Be careful. The price of the debentures, they're currently trading at €120 cumulative interest. So I have a price here, but it's cumulative of interest. Now you have not seen this before, but cumulative of interest means there is an interest payment due very soon. And the corporate tax rate is 12.5%. So what I've done is I've just taken note of those pieces of the puzzle. I'll show it to you on the document reader for a second here. You'll see what I've actually written down, and you'll have an idea, if I get it lined up right, of what's involved here. So what I read was, again, there were 1 million shares in the company, and the price of the share was cumulative of dividend. Be very careful. That's a problem. Then we have growth in the dividend over a period of time. So really what I have to do here is work out the cost of a dividend growing. So you've seen this before, and it will be a formula available to you. You don't have to memorize it in any way, but basically you'll have a dividend growing over a period of time. And I just make sure you don't mix up any of that stuff because that's all to do with equity. So you really your problem here is, can you figure out the dividend per share? Can you figure out the price ex dividend? Can you figure out the growth rate? Once you get those three little characters, you'll be in a position to calculate what's called the cost of the equity. So it's very like the last question, except for the pricing is a bit distorted, and we need to find the dividend and take it away from the price. The second piece of information is quite easy. It's not a problem. It's a preference share, and you just have to find the dividend, put it over the price. Sure, I have the price, and I should be able to figure out the dividends here. So I think you'll find that one relatively easy. So you just need the dividend. If you can find the dividend there, you'll figure out the rest of it, no problem. Now, this guy is a problem. What I'm saying here is that the company has a 10% coupon redeemable. If you have a redeemable, there is no formula. Nominal value 100 as usual. The price is given to you what's called cumulative of interest. That means an interest payment is due very soon, and it's 120 euro. Now, you know the interest. The interest is always based on these two guys. The interest is based on the coupon rate and the actual nominal value, 10 euro interest. It's only a case of taking 10 away from the 120. I'll show you that in the solution in a few minutes. And then you have what's called the price X interest. So tax rate is 12.5%. That's important. But the problem is there is no formula for calculating the cost of a redeemable debenture because they're all unique. They all have different time spans. This one has 10 years to run. So you can easily work out the cash flows from the company's point of view over the next 10 years, because I know the interest is going to be the same every year. But at the end of 10 years, the company would give back the 100. So it's a case of, unfortunately, calculating what's called an internal rate of return. So you have to, unfortunately, calculate an internal rate of return. So looking at the middle of page number 11 and looking at question number 2, I'm asking you, could you work out the cost of the equity and the cost of the preference share? Because that's very similar to the last question with one slight adjustment. The price of the share is cumulative interest. Then I'll bring you through slowly how to find the cash flows for the redeemable, and then maybe give you a handle on how to calculate the internal rate of return. This is something you need to practice. So I'm going to leave you with calculating the cost of the ordinary share and the cost of the preference share. And if you have any question, please, text me if you want in the chat box, or unmute your mic if you want. But I'm just going to give you maybe 10 minutes to see, can you calculate the cost of the equity and the cost of the preference share? If you want to go on to the cost of the debt, please do. That's based on what we did last week. So I'll just give you 10 minutes, see how you get on this one. me just show you how to approach this question. Again, it's very similar to the last question. I'm going to put it up on Moodle for you, so don't panic if you don't get to take down all the detail. But really, you're just trying to work on cost of equity first, then cost of preference share and cost of debentures. Now, probably in an exam, you'd probably do the preference share first. It's kind of easy, and then maybe the equity and the debenture. The debenture is the one that I'm kind of interested in here because you just saw this in action last week. But let's have a look at the equity. So what I'm going to do, again, I'm going to share it to you on a PowerPoint because at least it's better than my writing. So the PowerPoint information: 1 million shares, and the most recent dividend is 450,000 euro. So my opening line here would be to try and figure out the dividend per share. So hopefully you got this. The current dividend is 450,000. That's euros. That's for all of the shares, and there's 1 million shares in the company. So you take 0.45 of a million divided by 1 million, gives you 0.45 of a euro or 45 cents. That's what's called the dividend. I have the first little piece of the puzzle. In this question, you were given the price cumulative of dividend. Be very careful. So this crack here, if you're looking at the financial press and that, if you look at it, if you see a price cumulative of dividend, it means a dividend is about to be paid. It's reflected in the current share price. Once it's paid, it'll drop by the dividend. So it's 350 including a dividend, but I worked out the dividend per share at 45 cents. That's about to be paid. So just take away the 45 cents. Of course, I'll put it in euro format. It's 0.45 from 350, which is 3.05. So the price, including the dividend, is €3.50. Without the dividend is €3.05. You've got two parts of a three-part puzzle. The last piece of the puzzle is what's called the growth rate. So if I show you how the growth rate operates. Now the growth rate is complicated, but in this example, we have 5 years of data, which represents 4 years of growth. So that's just one to remember. Like the base year is year 1. After that, then you have to get to year 2 is 1 year, to year 3 is 2 years, etc. To get to year 5 will be 4 years on top of the base year. That's the expression. She started at 300, ends up at 450. So it grew about 50%. So that's what I'm writing down here, the expression for 4 years growth. It started at 300, ended up at 450. So it grew by 150 on top of a base of 300, 50%. So to the right of the 1 is the actual amount of growth overall, 50%. What you can't do here, however, is take your old 50% and divide it by 4, get about 12.5%. That's not the way it works. You have to figure out what number multiplied by itself effectively, 4 times if you want, gives me an answer of 1.5. So it'll be less than 12.5%, you'll see. So what you do here is you're trying to get rid of the 4, get the whole expression to the power of 1 over 4, and do the same for both sides. If I get this to the power of 1 over 4, it becomes just 1 plus g. I get the same thing done to the right-hand side, to the power of 1 over 4, or if you prefer 0.25. That's the style I tend to use. So with your calculator, if you put in 450 over 300, you'll get 1.5. Then you look for the power function on your calculator, and you put in 0.25 or something. And you'll end up with an answer. And the answer will be the number that if you multiply it 4 times, you'll get 1.5. So 1 plus g is 1.1067. It's very like the last one. Sure, it's the same question, except I changed it slightly. It's a slightly different rate of growth. The last one was something like 10.76. This is 10.67. Anyway, 1 plus g is 1.1. Take away the 1 on the left and the 1 on the right. G is 0.1067. Now we've got 3 pieces for a puzzle. We have identified the actual growth rate, average annual growth rate, about 0.1067. We've identified the price of the share without the dividend, and we've identified the current dividend about to be paid out. Of course, it will grow as we go forward. So then you have a little formula. Now, apologies if I'm going through this quickly, but it's very similar to the last question. So you'll be given a formula, as you know so well. That formula is available in the exam. You just have to put the information in. So what I'm testing and what the external examiner is testing, that you know how to find things like what is the dividend? What's the growth based on historical data? And what is the actual current market price? Once you have those pieces, you just have to apply the formula. So I just put in the numbers in here. I'm going to do it in cent. So that'll be 45 cents for the D. The price, I'll put in cent, because if I have the dividend, I must have the price. That'll be 305. And the growth is in decimal, 0.1067. So this is what happens. You have a calculator. You'll work out next year's dividend. It's 45 current, it'll grow to about maybe 50 cent or something in around next year. Put that over 305, you'll get an answer and add on 0.1067. Seemingly it turns out to be about 0.269 or something, about 27%. Now I appreciate there's a lot in that, but it's again a routine. If you're familiar with the process, you should be well able to calculate the actual cost overall. Even if you make a mistake at the end, if I see that you can get the dividend per share, you can get the price of the share without the dividend, you make a stab at the growth rate, you'll get most of the marks, no problem. You don't have to get the right answer. Just get something reasonably close to it. I'll be good. That's good for me. And when we look at the preference dividend, I'll run through this fairly quickly. The preference is quite easy because all you have to do with a preference dividend is look at the information for preference. It's 6%, €2. That tells me the dividend is 12 cent. And she's currently trading at €1.20. Just put 12 over 120. So that's the 12 cent. There's your 12 over 120. I'll get a decimal answer. I transfer to a percentage. So they were the first two parts of this. I hope you had a go at it. And it's not important that you get the right answer. It's just important that you try and figure it out. If you're making a hames of it, it's not working out for you. Don't panic. If you're trying, to be honest, you're learning. If by making mistakes, you'll learn. So don't worry if it doesn't seem to be getting there yet. With practice, and if you look over these questions, even if you try them again, you'll begin to get on top of it. It's just a case of practice, and with repetition, you'll get familiar with the process. Now, what is a little bit new, well, not so much new, is the third form of finance. So I'm going to introduce you to the redeemable debenture, and you have taken note, maybe what I wrote down. I'm going to show you the redeemable debenture now as well, and all of this I'll put up on Moodle, so don't panic if you're not getting this information down. It'll be up on Moodle later on. Anyway, 10% redeemable. Once you see the word redeemable, it's a pain. But more importantly, it's a pain that gives you lots of marks, right? So you'll be getting 6 or 8 marks here for the calculation of a redeemable debenture. And the most important thing is you understand there's no formula. To get the cost of a redeemable debenture, you have to get what's called an internal rate of return on the after-tax cash flows. The idea behind after-tax here is that the interest is what's called tax deductible. That's a bad English there for me. Yeah, I'll have to take out that cash flows. Two cash flows. We get that correct. Anyway, IRR on the after-tax cash flows. Cash flows are as follows. I think it's okay. Maybe yeah. Okay. The one thing that's different in this question is the price of the debenture is given at 120 cumulative of interest. So what I have to do here is just find the interest and take it away. So this is the weird thing you haven't seen before. Price cumulative of interest, CUMINT. It means there's an interest inside that price. As an investor, you can buy this for 120, but in a couple of days' time, you'll get 10% of 100. So if you take 10% of 100, it's €10. Just take away the €10 from the 120 and you'll end up with the price X interest. That's all I'm doing there, making sure you understand that the price X interest is actually 110. Now, it rarely happens. Usually I give you the price X interest. Usually if you're looking at questions in the textbooks, you'll be given the price X interest. But if you are given the price cumulative, find the interest and just deduct it, take it away. Now, on page 10, you saw the full process of this last week, and you may have practiced the question I suggested at the bottom of page 10. But how do you work out the cash flows? Now, there's a format for this. You treat it from the point of view of the company. The company has a choice: buy the debenture back and cancel it, or continue to pay the interest. So the format always starts with what's called the price X interest. You'll see this if you want a comparator. It's on page number 10. You'll see the format from last week. So the company could buy it back for about 110. If it did that, it would save the company having to pay interest for every year from years 1 to 10. So what'll go in here would be what's called an annuity, the interest element. Of course, the thing about interest is it's tax deductible. So I don't just put in €10 for each of the 10 years. I put in €10 multiplied by 1 minus t. So there's your old 1 to 10, no problem. If there was no tax in the world, I'd be writing a tenner here. But because we have taxation and interest is tax deductible, this is something you must remember: interest by 1 minus t. In this case, €10 is the interest. We know the interest is 10% of 100. and you multiply that by 1 minus the tax rate, 1 minus 0.125, which is 0.875 by 10, which is 875. That is the interest after tax. They're the after-tax cash flows. The redemption value is always 100. It's also called the nominal value or the par value. So if the company buys it back for 110 today, it won't have to pay interest after tax, and it won't have to give back the 100 at the end. Not having to do something is called a saving in finance, which is a cash inflow. So it's traditional to write them in that format. Now that's really critical. And that's just a follow on from what we did last week. And you might have practiced the question on the bottom of page 10 that I suggested last week as well. So what do you have to do? Unfortunately, you have to calculate an internal rate of return. That means you have to do some discounting. So in this question, you could decide any rate as an initial discount factor. You could try 5% or 10% or 12% or whatever you want as your initial discount factor. And when you get the answer, you'd have to interpret it. And then you'd have to do it again. So it's really painful, but it's something that you need to be familiar with. So I'm going to show you, and I'll make up an example. I had to try something. So I tried, for example, 7%. Now I could have tried 5 or 10 or whatever, just showing you this example. This is the example that I'll put up on Moodle for you. So what does that all mean? It means I'm going to discount these cash flows at around 7% to see what happens. Now, if the answer turns out to be a positive NPV, I'll know it's more than 7%. If the answer turns out to be a negative NPV, I'll know it's less than 7%. That's your understanding of the process, which I did with you in the very first 2 lectures. How to calculate an NPV, how to interpret, and how to calculate an internal rate of return as well. So I'm going to try 7%. So I'm going to run through this fairly quickly and we'll stop. But you should practice this. You should have a go, pick any 2 rates you want, get 2 NPVs and interpolate. I'll show you what I mean by interpolate in a second. So I try 7%. What does that mean? It means I go to the back of my handout. At the back of the exam paper, you'll have what I call discount tables. And I'm trying something like 7% as a discount factor. That's my choice. It's purely arbitrary. You can pick any rate you want, but you're just trying to see what's the story here. Is it above or below 7%? That's what you're really looking for. So what happens? Year 0 is in the present, nothing to be done there. But years 1 to 10, you'd know that as an annuity. So you'd be looking up your annuity table. Year 10 is a one-off cash flow. You're looking up your present value table. And the factor we're going to use is 7%. So I'm going to show you the numbers here, but don't try and take them down necessarily as maybe identify what's happening. So I go, this is my second cash flow. It happens in years 1 to 10. I'll write it down here. So you see 1 to 10, 875. This number here comes from your annuity tables. The back of your handout, you'd have annuity tables. And if you went and looked for 7% and went down to 10, time frame 10, you'll find something like 7.024. You multiply by the 875, you get an answer on the right. And the same crack with year 10. It's a one-off cash flow. It occurs in 10 years' time, at the end of 10 years. You'd look up your present value table, you'd look across till you get 7% and go down to 10. You'll find something like 0.508, multiply by 100, 50.8. What's happening here? I have 3 answers here. They're all in today's money terms. 50 and 61. You're going to get about 112 or something for this fella here. And then you have a negative 110. You're going to get a positive 226. So by discounting at 7%, and I know you have not seen all these numbers before and you have to go through this process of checking it out yourself. But when I get the answer, if the answer is positive, I know immediately the return is more than 7%. If the answer there was negative, I'd know it's less than 7%. So the purpose of this process is that it's a tedious process, but I just need to get 2 NPVs at 2 discount rates. So my interpretation here at this stage would be it's more than 7%. I'm treating it like an investment. So from the point of view of an investment, it's more than 7%. Same crack for the company. From the point of view of the company, it's costing them more than 7%. So what do you do next? And again, apologies, I'm running through this fairly quickly, but I'll put it up on Moodle for you because this is something you need to practice. So I'm going to try another rate. Logically, I should try something higher than 7% because I have a positive NPV at 7. So I try something like 8 or 9 or 10 or 11 or 12, anything you want, it doesn't make any odds, but something higher than 7. So I have to show you an example. I tried for the crack 9%. Doesn't make any odds, but something logically higher than 7. That's important because I'm trying to get NPV of 0 if possible. That's the idea behind an IRR. You're trying to get a discount factor that generates an NPV of 0. You're unlikely to get it, but you just need 2 rates and 2 NPVs. Then there's a little formula that brings you to the answer. So without going through it fairly quickly, if I tried 9%, what happens? I'm just going to have a discount factor of 9. I have the exact same cash flow, exact same time frame. But these lads here, the numbers that were related to 7% would be different. If I try a higher rate, these numbers will fall. They will come down. So I'll just show you reasonably quickly with 9%. We're about to stop now in a few minutes. So same crack for year 0, nothing to be done there. But year 1 to 10, watch what happens. The 7.024 drops down to 6.418. Now don't try and take down these numbers, but you understand, I'd look up a set of discount tables at 9% from 1 to 10, and I'd find under the 9% across from the 10, 6.418. The year 10 is a one-off cash flow. I go to the present value tables, watch what happens again. What was 0.508 drops to 0.422 because it's a higher rate, therefore a different factor. And I get a bunch of numbers on the right here. These numbers come from what are called tables. That's an annuity table. That's a present value table. So just be careful, you know how they work. And then if you add the 56 and the 42, you're only at about 98 or so. You're way off the 110. If you take away the 110, you're going to have a negative here, substantial negative. It turns out to be 11.64 in my example. Now, it's not important. You don't have to get a positive and a negative, or a negative and a positive. You can get 2 negatives or 2 positives. It makes no odds. You just need to get 2 NPVs. And then very quickly on the next page, I'll show you, if I have 2 NPVs at 2 rates, there's a thing called an internal rate of return approximation formula available to you in the exam. That's the lower rate, happens to be 7 for me. That's the higher rate, happens to be 9 for me. The NPV at the lower, the NPV at the higher. So you have these kind of little pieces of information here. They're just a bunch of numbers. This thing just simply brings you to a kind of an averaging technique that generates an approximate internal rate of return. So you just input these numbers. Be careful with the B here, you're going to have a double negative, minus a minus 1164. So very quickly, if I show it to you, and I know I'm running through this fast at the end, but this is something I need you to practice between now and next week. If you put all these numbers in, really, it's above 7 by about €2. It's below 9 by about €11. So the answer is closer to the 7 than it is to the 9, because I was out by 2 and a bit. Here I'm out by 11 and a bit. So all this thing does here is it brings it towards the answer. So it's above 7, but not that much above 7. It's a good bit away from 9, a good bit below 9. I got an answer of a 7.33. Now, obviously, if I tried 5 and 10%, I would have got a different answer. But it'd be still very close to this answer, honestly. If you check it out, you try any 2 rates you want, you'll get something very close to 7 or 8%. I did it on Excel, so I use a computer just to generate the answer, and it gives me a perfect answer. The actual answer is 7.31. This thing I'm doing here is what's called an approximation technique. So based on 2 discount factors, I get an approximate IRR. That's the actual IRR using an Excel spreadsheet. So you could try 2 different rates. You'd have gotten an answer. It wouldn't be too far away from 7.3. It might be 7.5, 7.6, 7.1. It'll be something not too far away from 7.3. At the end of the day, there was a second part of this question that simply says, make a commentary. So I found cost of equity was 27%. So that's the most expensive. Preferred shares were at 10%. That's a bit cheaper. And the cheapest will always be the debenture issue. You'll find this as you go through every question. And it's all to do with this idea that equity or ordinary shares take the biggest risk and demand the highest return. Preference shares take a little bit less risk, so they demand slightly less return. And the debenture holder is the interest guy. He gets paid first, takes less risk, and it's tax efficient. So that tends to be the case. The commentary was harmless here. Most expensive equity, followed by preference shares, and the cheapest was the debenture. Now, I've done an awful lot there in that last piece, but a lot of that is not something that's difficult. It's just practice. So what I thought you might do for me between now and next week is, obviously I'll put this up on Moodle and check it out. But if you wanted to try two different rates and see what happens, it would be, you should get an answer in around 7 to 8% or something. And also I'd like you to have a look at question number 3 on the same page. And what I will do next week with you is I will go through question 3 reasonably quickly, and we try and tie it all together. We're more or less at the end of the very first topic. We're just going to do a series of questions until you're comfortable and okay with the whole process. So I'm going to take this overhead down and again, open it to you if you wanted to ask something. These overheads will be up on Moodle a little bit later. So don't worry if you don't get to take all the detail of the numbers down. I will put them up on Moodle for you so you can look at them slowly. But if you wanted to ask a question, if there's anything you have a difficulty with, please do. I've done a lot there in that session. But if you are unsure of anything, or if you want to ask something, you can unmute your mic, or if you want to put a question in the chat box, please do. But we're finished for today. You could have a look at question 3 maybe on the bottom of that page. Apologies if I went very fast there at the end, but I just want to show you an IRR. It's a routine. Just have to get comfortable with the routine. So we'll stop. If you're okay with this, we'll chat you next week. And we will just, we're well over halfway through the course for me. We're making our way towards the very end of the first major topic. So take her handy for the week, and I'll chat you soon. I'll wait for 5 minutes in case somebody wants to ask anything. I'm not too sure about next Monday. Is it a holiday? I didn't know. I'll put something on Moodle if there's a problem. Definitely the answer for that last one is close to 7%. It's not 14%. If you want to show me your workings, I'll identify where the mistake is. If it's a bank holiday next Monday, sorry, yeah, then you're free. But I'll check it out for you. I'll put up that overhead again for you and just bring you through it just to make sure you're okay with that overhead I just pulled down. And I'll show you what's happening. Get the right overheads as you. 1 second now. So Nicola, I'm not too sure if you can hear me, but anyway, bottom line is how to calculate this thing. This is the way you do it. You do this calculation first. You'll have 2 over about 13, which is quite small. And you multiply that by 2 effectively. 9 minus 7 is 2. So you'll end up with an answer here, probably very, very small. 2.26 over approximately 13 or 14. It's going to be a small number. You multiply that by 2 and you'll get about 0.33. And finally, you add it to the 7 at the end, which will be a 14. I don't know if that helps you, Nicola, but you do it in a sequence. The last thing you touch is the 7. The 7 is at the end. It's 7 plus the following calculations. No problem. That's great, Nicola. I think you have it. Again, just be careful with that calculation. It can be tricky. If you're all good, I'll finish up. So I'll close down the meeting if that's all right with you. So have a good old week. We'll chat you soon. And if Monday is a bank holiday, we're not on, that's for sure. I forgot about that. No problem.